All right, good evening, everybody. My name is Mike Flewelling with BECU Investment Services, and I'm here to introduce our Student of the Market Introduction to Investing webinar with Jason Piper of MFS. And so I'm going to do a quick disclosure, and I'll give you a little bit of background about Jason and MFS, and I'll turn over to Jason for the presentation. So the opinions voiced in this webinar are those of speaker Jason Piper with MFS. Opinions expressed are for general information only and not intended for specific advice or recommendations. So a little bit about Jason. Jason partners with us with a firm called MFS. He is in mutual fund sales in Western Washington and Alaska. He began his career in the financial services industry in 2003 as a client services representative in the MFS Service Center. He was promoted to the role of wholesaler in 2007 and was made regional director in 2008. He earned his bachelor degree in business administration from Western Washington University, lives in Seattle with his wife and 2 children, loves exploring Washington, Arizona, and Europe with his family. And a fun fact that Jason and I have realized after a couple of these presentations is we both Jason actually grew up in a town called Elma, out near the coast, and I actually lived there for a short period while I was a child, and so it's a small world. A couple of highlights about MFS. MFS essentially created the mutual fund in 1924 in Boston, Massachusetts, and today they are consistently recognized for long-term performance by Barron's. So with that said, I will turn it over to Jason. It's all yours.
Great. Hey, thanks, Mike. Appreciate the introduction. Good afternoon, everyone. My name is Jason Piper, and as Mike said, we both lived in Elma, Washington. I'm born and raised there, so small world and definitely a small town. What I'd like to do today is talk about being a student of the market. So we're going to talk about some of the things that we know about the market, and we're going to talk about how we can put a process in place to help us take advantage of what we know about the market and give us a better chance of getting the outcome that we want, whether it's retirement or funding educations or leaving a legacy of significance. So I'm going to talk about those topics today over about the next 30 minutes. But what I'd like to do is I'd like to start with a story. This story starts out in Kalispell, Montana, which is the northwest corner of Montana. It's a beautiful place, but it's a long ways from anywhere. And so I was working in Kalispell, Montana, and I had finished my work where I lived, a small puddle hopper airplane, and it was seat number 1. So I sat down, got myself comfortable, getting ready to take off, and of course, the last thing that you do before before the airplane takes off is you close the door. Well, I'm watching the flight attendant try to close the door, and it's not working. So she's trying to close it, pulling levers, metal's clanking. I can see that it's not closing. She's getting more and more frustrated. And finally, after about a minute of her trying to close the door, she turns around, she looks at me, and she said, "Oh my, I hope that closed." Now, if you've ever heard that it's safer to fly than it is to drive, you can probably understand that at that moment in time, I did not feel that way. And I think that's very similar experience to how approaching the markets is right now. We've been told over decades that the markets are a great way to grow our money, to help our 401ks and our 403bs become much larger so that we can retire. But then the market volatility and market events come along and they make us rethink that. So I want to talk about just a couple of the long-term key aspects of the markets today, and then we'll talk about putting a process in place that helps us take advantage of those things. So before I do that, let's talk, there's a little disclosure. I'll give you just a moment to read that, all kinds of legal stuff about what we'll talk about. Let me just tell you a little bit about MFS. So Mike did a great job of introducing MFS. We're the first mutual fund company. We invented the mutual fund in 1924 in Boston, Massachusetts. Now, that was revolutionary because before the mutual fund, if you wanted to buy a share of, say, General Electric, it would cost you $232. The common wage earner in the United States was making $5 a day. So it was virtually impossible for the common average wage earner to be able to invest in the markets. And you didn't always get your money back if, say, you wanted to cash in those shares of General Electric. They actually had to physically travel. Your certificates had to travel to an exchange to find a buyer. It was much more difficult to invest back then. The mutual fund was started for a group of sea captains. The sea captains did have a lot of money, but they were also gone for long periods of time, and they needed their money to be well cared for while they were gone. And most importantly, they needed to get it back when they came back. So we invested in 45 companies. We put them into the fund, which means everyone shares in the expense, everyone shares in the performance. And when we did that, we revolutionized the way that people invest. Now, the common average wage earner could access 45 companies. They had diversification, they had professional research, and they had liquidity. So you fast forward to today, almost 100 years later, the mutual fund is one of the most common investment vehicles used for investors of all types to access all kinds of global markets. And MFS is the company that started that. So it's really, really a wonderful history. So let's talk a little bit about what are some of the common questions that we have heard over the years about investing in general. Things such as, how much money do I actually need? How do I know how much money I need to retire? When should I start? Is there a point in time where it's too late to start? What if I pick the wrong investments? There's a lot of choices. In fact, there's an overwhelming number of choices today. What if I don't pick the right ones? And then finally, how do I know how do I make these important decisions on my own, or how do I have enough information to make these important decisions on my own? I want you to think about it like this. Many of the important financial decisions and decisions we make in life, we make with advice, right? So if you're going to buy or sell a house, you usually consult with a real estate agent and somebody to work on possibly a mortgage. When you have health issues, you talk to a doctor. When you have things such as wills or legal issues come up, you talk to a lawyer. And we believe that your retirement is one of those times where it really helps to consult with a professional. Now, many of these questions and many more can be answered by working with a financial advisor. And so what I'm going to do is talk about how that works, and then share with you how we at MFS work with the Boeing Credit Union Wealth Management team. So first off, all of these questions that we have, we can kind of sum that up into, what are my goals? And the way that I like to say it are, what are the hopes, goals, and dreams that I have for my money? And every person has a different answer. That's one of the great things about this business, is very individual. So some people want to retire. Some people want to be able to travel more. Some people want to be able to help their children or help their grandchildren, or leave money to a charitable organization or to a church. Those are all goals that we can work with, and we can set, and once we understand what those goals are, we can start working towards them. And sitting down with a financial professional can help you really articulate and put down, onto paper, so to speak, what those goals are and what your unique timeline is, because every timeline is different as well. And then once we've done that, now we can start talking about things such as staying ahead of inflation, which is one of the key reasons that we invest in markets. We can talk about what allocation makes the most sense. So how much stock, how much bond, what about other investments that we might own that are going to be the right mix to help us reach our goals, but also help us sleep at night, because that's a really important part of it. And then finally, how do we stay the course? One of the most beneficial things that you have access to is time. And we'll talk about that in a minute. But staying invested and sticking to a plan can be one of the most challenging parts of it for many investors, especially when uncertainty arises. And I could say, this year and even today, we're seeing more uncertainty than we have in quite some time. So how do we put that process in place? And then let me just share a quick note on how do we at MFS fit into that. I'm going to go back to the doctor analogy. When you go to a doctor and you have symptoms of something, they prescribe you a medication. Now, they didn't make the medication. Most likely, they don't work for the company that makes the medication. And they have access to lots of different medications that they can put together for your unique situation. And working with a financial advisor is very similar. I wouldn't say that they're a doctor, but in this analogy, they're similar to a doctor. They're going to understand your unique situation, and then they're going to pick from a very wide list of investment managers and products that they have available to help you get to that point. So just to give you kind of an idea of how we all work together. So let's talk about being a student of the market. Let's talk about a few of the key core aspects that are really important to understand. So the first one that I think is just so interesting is the concept of inflation. Now, inflation has been something that we've heard a lot more about in recent years, and even probably experiencing it more. Everyone here experiencing it more today than we have in many, many years. So what we wanted to do is just give you a couple of examples of what does inflation really look like. And as a brief definition, inflation is just the rise in costs of goods and services over time. So a perfect example here is a gallon of gasoline. In 1970, it says 40 cents. I go back to Elma, Washington. There was a gas station about 3 blocks from where my parents live. And the lowest number I can remember on the sign was 98 cents a gallon. Today, this says $3.36 a gallon. Clearly, they're not using Washington State alone in this calculation. This is an average. But you have over 700% inflation in gasoline since 1970. Take a look at milk, $1.32 in 1970, which seems high to me. Fast forward to 2022, $4.21. I know I paid quite a bit more than that at the market down the street not long ago, and that represents an inflation level well over 200%. Take a look at college or a public education. In 1970, $350. Those were the good old days. Fast forward to today, the average in the United States is well over $10,000, and that represents a 2,900% inflation rate. So we have to understand inflation because when we're investing for these long time frames, so this is a 50-year time frame, but the average time horizon in retirement today is about 30 years. So we have to really think about what is inflation going to look like for the next 30 years or for our time horizon. And we have to match our investments to at least keep pace with, if not beat, inflation. So actually, I'm going to back up 2 slides here. There's one other slide that I'd like to show you about compounding. So compounding is it's a wonderful phenomenon. In fact, Albert Einstein called it the 8th wonder of the world. He said that those who understand it receive it. Those who don't pay it. Okay, so what is compounding? Compounding, the simplest way to say it, is money growing on top of money. Okay, so we put a hypothetical example here of $1,000, and we put 3 different rates of growth. So we have a 3%, which is at the bottom, 5%, which is at the middle, 6%, which is at the top. $1,000 from 10 years out to 40 years. And so here's how compounding works, and this is why it's so important to have time on our side. So $1,000 after 10 years, you can see the difference between 3% and 6% isn't that dramatic. $1,300, a little over $1,300 to $1,700. When we go out to 20 years, the difference between 3% and 6% is not quite double, okay? But then look at what happens when we start getting into the 30 and the 40-year time frame. 3% turns into $2,400 after 30 years, $5,700 at the 6% rate. So now we've more than doubled, but then look at the 40-year number. 3% is 3,200, where 6% is over 10,000. So now we've tripled at the 6% rate. So the goal is to earn through a mix of investments and lots of other vehicles that are available to earn a rate that's going to compound over time. And you can start to see that the better the rate we're getting, the more compounding that we get. And you can really understand why Einstein said this is the 8th wonder of the world. So we want to put compounding to work within our portfolios. Okay, so how do we do that? There's lots of things that we have learned about the market over many, many years, but the challenge is putting a process in place that allows us to take advantage of what we know, but also protect us from some of the behaviors that can get in the way. When I talk about the volatility, those are things that can make us nervous, take us off track for reaching our hopes, goals, and dreams. So how do we put a process in place that protects us from that? We call this process allocate, diversify, and rebalance. And once we understand what the goals, hopes, and dreams are that you have, we can put this process in place. How does it work? First off, we allocate. And allocating just simply means allocating to a mix of investments that is appropriate for our risk tolerance and our time horizon. So what we've put on the screen here is 3 different investments with at the very bottom of the screen being inflation. So remember that what I said was inflation, beating inflation is one of our key goals. So what does it look like to be in some different investments, and how have they performed against inflation for about 40 years? So at the bottom, we have the consumer price index. That's the measure of inflation in the United States. And that has had a rate, the average rate has been about a little over 3.5%. Now, I do want to caveat by saying this. Up until 2022, from 2008 until 2022, the inflation rate has been well below the historic average. So when you look at how well the market's done and how low interest rates were and all of those things that we've experienced over the last decade, that was a historic low point for inflation and for rates. We're coming out of that and coming to a much more normal environment today. And so that's why what we're going through may seem a little uncomfortable. It's because we lived through the lowest inflation and interest rate period of time that's happened in modern history. So the average for 40 years, 3.5%. Cash on average has been at about 4.3%. But again, cash rates have only recently gotten back to 4%. From 2009 up until really 2022, cash rates were virtually zero. And if you think about what zero would do to a portfolio for 10 years, you wouldn't have even outpaced inflation in cash. Look at US bonds. Now, bonds are just a loan. A bond could be a loan to a government. It could be in the form of a treasury. They could be a loan to a company. They could be a loan to a municipality. They could be a loan to a mortgage lender. There's all kinds of bonds that are available out there. And over this time period, bonds have had an average return of about 6.5%. So they've outpaced inflation, but not much. And then finally, look at the stock market. And this is just the S&P 500. So, a broad measure of 500 companies in the United States, 500 of the largest companies. Your Microsofts and your Amazons and Costco's and Teslas of the world. And when you look at the stock market, the average return over this time period has been a little over 11%. The interesting thing here is that if you were to look at even a longer time period that would take in, say, from when the mutual fund started in 1924, you would still see that the average return on the stock market over about a 10-year period is somewhere around 10%. So this is one of the reasons why we look to the stock market to help grow our investments, is because pretty consistently over many decades, it has delivered a return that has been in the low double digits. And if you think about it, why is that? Well, if you're shopping at Costco, if you're buying coffee at Starbucks, if you're putting gas in your car, whatever you do day to day, week to week, month to month, those are the things that drive the U.S. economy. And these companies that we can invest in are taking advantage of that. So if you buy a cup of Starbucks every day or whatever your frequency is, and you happen to be a Starbucks share owner in some way, you're benefiting from that. And that's why the market has continued to grow over time. It grows as our economy and the number of people buying stuff in the United States and around the world grows. So you can see lots of different options here. There's many more than what we show here, but this is why we allocate to markets with stocks and bonds and other investments so that we can outpace inflation. Okay, now let's talk about diversification. Diversification, the simple way to say it is not putting all of your eggs in one basket, spreading out your risk, spreading out your opportunity set, and hopefully dampening your volatility. So what we're going to do is we're going to go through a little exercise here. Take a look at the screen. You're going to see a lot of colors. We call this a quilt chart or a jelly bean chart. But what it really is this is data, okay? So each column is a year. And within that year, as you go from top to bottom, what you will see are different asset classes represented by these colors. So you can see on the left, kind of a lightish blue at the top, purple at the bottom. Lightish blue was the best performing asset class of that year. You drop down to the bottom, that was the worst performing asset class of that year. So here's what I would ask you to do. Whether you want to trace with your finger, pen, visually, on the left-hand side of the screen, in the column on the left-hand side of the screen, pick your favorite color, whatever color it is, and connect the dots on that color across the page. And just see what happens as you kind of draw the line across the page. Now, I've done this presentation to hundreds of groups, and almost without fail, when I say, what do you notice? I get the same answer. It's all over the place. Whatever it is, it could be the red box, which is international. It could be the yellow box, which is actually cash. But basically every category, every investment category has some kind of volatility over time, right? There's nothing that's at the top every year. There's nothing that's at the bottom every year. But there is one that doesn't quite have the same behavior as all the others. And that is it looks kind of a very darkish gray. I call it the black box. And that's right in the middle, the diversified portfolio. All the diversified portfolio is an equally weighted mix of all the other colors, just inserted into the chart. And what you'll notice is that it never hits the bottom. It never hits the top. It kind of moves right down the middle over this time frame. Now, take a look on the right, and you're going to see the average of these investments over time. And to me, the most important observation is that the diversified portfolio lands right in the middle. So this is why we diversify. It helps us dampen volatility. It helps us capture opportunities in other parts of the market. You know, in this chart, you have international, you have real estate, you have small and mid-cap companies, you have bonds. So it gives us the opportunity to find other opportunities, dampen our volatility, and spread out our risk. So that's why we diversify. Now, finally, a quick disclosure for you, and then let's talk about the concept of rebalancing. Now, I'm going to assume that when it comes to advice in the investment markets, you've heard the phrase buy low, sell high, okay? It works every time, but it's much easier said than done, okay? So buying low and selling high is, very, very simply the way that you make money investing. But how do you put a process in place within your portfolio that allows you to do that and really forces you to do that without having to think about it or without having to push any buttons? That's what we call rebalancing. So how does it work? In this example right here, you're going to see on the left-hand side, you're going to see a pie chart that says 50% stock and 50% bond. We use this for illustration examples. What might work for you might be a different allocation, but this just makes our example easy. So this started in January 1st of 2013. Now, let's say that this investment was made and whoever made the investment never went back and touched it again until 12/31/2022. So 10 years later, December 31st, 2022. What you will notice is that portfolio actually went from being 50% stock, 50% bond to being 75% stock, 25% bond. Why is that? The stock market grew significantly over that period of time, and it grew much faster than the bond market did. So at the end of the day, or at the end of that time period, the amount of money in the stocks was significantly more than it was in the bonds. Now, if we were rebalancing, what we would do is over some periodic basis, the studies will tell you sometime around once a year is fine. If you want to do it more often than that, you can. We would go back, we would make sure that everything is the same with our risk tolerance, our time horizon, everything that we had set out with, and we would reset back to that 50-50 portfolio or whatever your portfolio is. That is rebalancing. But what it really forces you to do, in this example, we would be resetting back to 50-50, which means we would be selling off some of the stock and buying some of the bond. and then we'd be selling off some of the stock again and buying some of the bond. And so what it does is it forces you to sell investments that become expensive and to buy investments that become cheap. And by doing that over time, what we have found is that that process works better than chasing performance, which is always buying what did better the year before, or what we call going for the rebound, which means always buying what was the worst performing asset class, hoping for some kind of big bounce. Rebalancing gives us a better outcome, but here's what I think is really the key. Rebalancing is something we can control. It's part of the process. It's part of the process that we have control over. And my belief is that having control over some of these things gives us the confidence to stay invested and to stick with the time horizon and stick with the plan. Because as an investor, there are a lot of things that we have no control over. If we can put rebalancing in, if we can put the whole process, allocating, diversifying, rebalancing into place, it gives us a process to have control over. Okay, let's just quickly review some of the key points that we've talked about. Number one, market performance. Relative performance of asset classes changes over time. And that's why we want to have a mix of different asset classes so that we can capture those changes and we can dampen out the volatility over time. Number two, stocks outperform bonds. And this is, I don't want to make any guarantees here, but what history has shown us is that stocks have outperformed the bond market. I don't see any reason why that won't be the same going forward. But we do expect that, or we do find that owning a mix of both for most investors is a great way to take advantage of the growth of the stock market, take advantage of the income that is produced from the bond market, and also take advantage of the different performance streams and profiles of both of those areas. And then finally, rebalancing. Consistently rebalancing can help keep an appropriate level of risk, and it forces you to sell investments that become expensive and buy investments that have become inexpensive. So let's just talk about staying invested. Okay, what I said in the beginning is that time is one of your best friends. And when we look at periods of time in the market, and the question is this: what happens if we missed some of the best days in the market? So a couple of things to think about here. Number one, returns are not linear. Just because the market was up 1% yesterday does not mean that it's going to be up 1% today or 1% tomorrow. Sometimes you have days that are up significantly. Sometimes you have days that are that we call corrections that are down significantly. And so the market is actually, it's constantly moving up and down, hopefully with a trajectory that moves up over time. But here's the question: what if we missed some of the best days in the market? What would that do to our returns over a long period of time? So in this example, $10,000 invested in 2012, January 1st, 2013. And the question is this: what happens over that period of time if we missed, 2003? What happens if we missed the 30 best days, the 20 best days, the 10 best days, or if we just stayed fully invested and didn't think about it? Well, if you miss the 30 best days, that $10,000, you'll see it at the bottom, is only $11,700. That's a little bit over a 10% return over a 20-year period. Probably should have just left your money in cash. Take a look at the 20 best days. You missed the 20 best days in the market, your $10,000 is only $17,000. Not bad, but you'll see, not what it could be. If you missed the 10 best days, your 10,000 turns into 29,000. So it nearly tripled. But let's say you stuck to the plan, you didn't think about it, we had the process under control, and we stuck to that. The fully invested investor, that $10,000 turned into almost $65,000. So that's over 6 times as much as they started with. So as you can see, missing days in the market can be very detrimental to your investment outcome over time. In fact, the difference between the 10 best days and fully invested is 50%. So it's very important to have that process in place and stick to the plan. Okay, so let's just summarize some of the things that we talked about. Here's what you can expect when you're working with a Boeing Credit Union financial advisor. Number one, you can expect to put your goals down on paper and really start to think about what is it you really want as an outcome as you retire and move into those later years of your life. Number two, they're going to help you build a plan. And what we know is about writing down goals and building a plan around them gives us a much higher chance of success in them actually coming true if we just do those two things. Number three, once you develop the goals, develop the plan, we can put the investments to work. And that means finding the right mix of investment, stocks, bonds, plenty of other vehicles that are available to match the hopes, goals, dreams, and time horizons that you have for your money. And then finally, and I think probably most important, they'll help you stay on track. They'll give you somebody to talk to when maybe the market doesn't feel well, when things change in your life, when all kinds of different situations can arise. They'll give you someone to talk to and be able to walk you through those and help reposition your plan as we need to. So I'm going to end by saying this. I appreciate your time. I hope that this gives you some insights into what being a student of the market is all about. You know, the market's always changing. It's becoming more and more complicated as the years roll by. And working with an advisor, and there's many great and very experienced advisors at the Boeing Credit Union, can help you make sense of a lot of these things and get you pointed in the direction that you want to go. Thanks for your time. I greatly appreciate it.